All right, I want you to imagine something for a second. Let's say you started investing way back in 1985. For a couple of years, things are looking great, your money is growing, life is good, and then suddenly it's not.
Yeah, because that's the thing, right? To get to the incredible reward at the end, you first have to survive the ride. And wow, what a ride it's been. Let's take a look at the absolute storms a long-term investor would have had to face.
So first up, bam, it's 1987 and Black Monday hits. Wall Street has its worst single day in history, total panic in the streets. But you hold on. The market slowly claws its way back just in time for the dot-com bust in 2000. All those tech stocks just go into a complete freefall. You hold on again, and things finally start looking up right before the 2008 global financial crisis nearly brings down the entire system. And just when you think you've seen it all, 2020 rolls around, and a global pandemic causes the worst economic crash since the Great Depression.
Now, what's easy to forget when you're just looking at charts is the pure emotion of it all. During these crashes, it's not just numbers on a screen. Your friends, the same ones who thought you were a genius a year ago, are now literally on their knees begging you to sell, saying just lock in what you have left before you lose everything. The pressure to just give up is absolutely immense.
But what happens if you don't give up? What's the actual reward for weathering all those once-in-a-generation storms, one after another? Well, let's get to the good part, because this is where the story gets really, really interesting.
So after all that chaos, all the crashes, all the moments of sheer terror, what do you think the market's average annual return was over those 40 years? Get this, it was an incredible 11.23%.
Now, to capture that growth, you're probably thinking you'd need to be investing thousands and thousands of dollars, right? Nope. This whole hypothetical journey was based on investing just $250 a month. That's it.
And the result of that small, consistent investment? By simply holding on through every single one of those terrifying lows, your portfolio would have grown to over $1.8 million. I mean, just let that sink in for a second. That is the unbelievable, mind-blowing power of consistency and time. Okay, so seeing a number like that probably has you thinking, all right, you've sold me on the why, but what about the how? Well, the good news is getting started today is so much easier than it was in 1985. It really just comes down to 3 super simple steps. Step 1, open an account. You can do this online in like 5 minutes. The key here is to use a tax-advantaged account if you can, something like a Roth IRA in the US or an ISA in the UK. It just protects your profits from taxes down the road. Step 2, add some funds. It doesn't have to be a lot, just start with whatever you're comfortable with. And finally, step 3, and this is the most important one, automate it. Set it up so that money goes in every single month without you even having to think about it.
But okay, what should you actually invest in? For a beginner, trying to pick individual stocks is insanely hard. So instead, there's this brilliantly simple strategy that lets you basically invest in everything all at once. Let's call it the music chart strategy.
So first, you just need to know what an index fund is. Think of it like a big shopping basket that holds a tiny piece of all the stocks in a major market index, like the S&P 500, the 500 biggest companies in the US. So instead of making a risky bet on just one company, you're making a broad bet on the entire market.
And this is where that music chart analogy really clicks. See, an index like the S&P 500 isn't static. It's constantly updating. Successful companies, your Apples, your Amazons, they rise to the top of the chart. But here's the magic part. If a company starts to fail, like a one-hit wonder falling off the charts, it gets dropped from the index and replaced by the next big thing. You don't have to do a single thing. The system cleans itself out.
So why is this such a game changer for beginners? Well, for one, boom. Instant diversification. You own a tiny slice of hundreds of companies, so your risk is spread out. Second, it's automatically self-cleaning. You never have to worry about a failing company tanking your portfolio because the market just does the work for you. And finally, you can truly set it and forget it. If you pick an accumulation fund, even your profits get automatically reinvested to buy more, creating this incredible snowball of growth without you lifting a finger.
So now you know the story, and you've got the strategy. But maybe you're still thinking, I don't know, isn't it risky? What if I just wait for a better time? And that brings us to the most important point of all. We need to redefine what risk really means. Just look at this. Look at the difference a single decade makes. The first bar shows your potential growth if you start at age 25. The second bar, that's what happens if you wait until 35. That massive, massive gap between them. That's the colossal, life-changing power of compound interest that you just can't get back. It is insane.
So here's the thing. We are all so worried about the risk of a market crash. But the data shows us again and again, the market always recovers. The real irreversible risk isn't losing money in a storm. It's losing decades of growth because you were sitting on the shore, too scared to even set sail.
The market storms are a guarantee. They're going to happen. But the data also shows us that the incredible rewards for those who have the courage to ride them out are a guarantee too. The history is clear. The path forward is simple, which really just leaves one question. What are you waiting for?